Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Weekly for Saturday, March 20th, 2021. And our top story today, the Fed pledges lower interest rates through 2023. Well, joining me now to discuss this and a lot more is Dr. David Kelly. He's Chief Global Strategist of JP Morgan Asset Management. Dr. Kelly, David, great to see you. Thanks so much for joining us on the program this morning.
Sure, glad to be with you.
And I'm really interested to get your reaction. You know, the Federal Reserve, as I know you're aware, many of our audience are aware, met this week and basically made a pledge that they may not raise interest rates up through 2023. But I want to get your thoughts about this.
Well, they're trying to stay with the same tune. The problem is that the lyrics are getting brighter. Some of the notes are changing, and this tune is sounding a little, out of tune at this stage. So what they said is they do recognize the economy is strengthening. They do recognize that the pandemic is receding, but they also think there's a lot of uncertainty out there. So they still say they won't raise the federal funds rate, they don't think, until 2024. But having said that, they've also really upgraded their forecast for economic activity during this year, for inflation, lower unemployment rate down to 4.5% by the end of the year. So I think that really raises questions as to whether they can go all the way until 2024 before they raise short-term interest rates. And if you look at the bond market really does think the Federal Reserve is going to have to tighten a little faster than the Federal Reserve is saying.
David, I mean, it's really hard to think about things 1 year from now, much less 2, 3, 4 years from now. Is this just trying to have the right language so that the market responds appropriately, investors respond appropriately, I guess, in their eyes?
I think that's a lot of it, because what they don't want to do is push up long-term interest rates today. The problem is that what they're trying to do is provide honest forward guidance on their future activity. But if they were to honestly say, look, we think the economy is going to be pretty much recovered by 2023, we'll obviously push up interest rates then. If they said that now, interest rates might go up more today. So they're trying to avoid that by saying, well, we're not so sure, and maybe we'll wait till 2024. The problem is the markets can sort of smell that insincerity about what they're saying. The reality is the pandemic is receding, and even more importantly, from an economic perspective, there is massive fiscal stimulus pouring into the economy right now. And the combination of those two things will lead to much stronger economic growth, probably the fastest economic recovery we've ever seen. And that should really lead to a faster normalization of interest rates than the Federal Reserve is willing to admit right now.
David, what does this mean for other central banks around the globe? I mean, obviously the U.S. is the standard, the dollar is the currency standard. A lot of people look at what the Federal Reserve do, given our status in the world's economy. What do you think happens abroad?
Well, I think in other developed countries, the central banks are honestly playing the same game. You can see that in Europe, where the ECB is still talking about further bond purchases, despite the fact that inflation is beginning to creep up. And Europe has been slower on the vaccination efforts, but they'll still get to herd immunity, we think, by the end of the year. So they're going to have a big bounce back in the economy also. And same thing with Japan. So I think other central banks are all trying to keep interest rates low. But again, I don't know if that's going to hold as the economic activity improves around the world, and you've got all this fiscal stimulus pushing up economic activity and demand.
David, when it comes to advisors, people who are advising clients, whether they're institutions or individuals, high net worth families, what do you say to them? What kind of information would you provide to them, or reaction would you provide to them in terms of working with their clients?
Well, I think it's important to recognize that tough as times have been, and very tough as they've been over the last year, things are going to get better. That doesn't necessarily mean markets just continue to go up. I think it will be challenging. We do think long-term interest rates are going to go up. So that means in terms of bonds, you don't want to be too overextended in the bond market. Keep your durations short. Don't take a lot of risk. And then in the stock market, there are some things which have been very high-flying, some mega cap growth stocks. There's some areas of speculation outside the stock market. You've got to be careful about those too. So I think this is a time to really be careful about valuations. If you look at value stocks in the United States, you look at some small cap stocks, you look at some international stocks, both in emerging markets and around the world, there are reasonable values out there. I think there are also plenty of opportunities in some alternatives like real estate or global transportation or infrastructure or perhaps alternative energy. There are things to do here, but I think it all has to start with honest valuations rather than just riding the wave of momentum that we've seen in recent years.
And David, what about consumers here in the States? This pledge, through 2023, what could this mean for example, even though it doesn't have a direct relationship, it's the federal funds rate and not the direct relationship for things like credit card, loan interest rates. We've seen mortgage rates begin to creep up. What about the American consumer, some of whom may have gotten these COVID relief checks or this quote unquote stimulus check?
Well, I think consumers are in very good shape here, and I think one of the interesting parts about this, or one of the many interesting parts of this relief bill, is that by giving so much money to low and middle income consumers, this is actually a bonanza for the credit card companies and the auto loan companies, because all those people who were teetering on the edge, maybe they wouldn't be able to make their payment, maybe they were 60 days delinquent, a lot of these people are going to be able to catch up now. And I think that means that you'll have fewer loans go bad. So I think that's one part of it. But I do think we'll see higher interest rates. I mean, for consumers, the most important interest rate is that mortgage rate. And I do think that long-term mortgage rates will go up, as they should, as the economy improves. But that still makes, if you're at the right point in your life, you find the right house, it's still a very good long-term investment. You're just going to have to pay a little bit more for the mortgage.
Last question, David. Anything you mentioned that the Federal Reserve sees really positive economic data. Anything that might give people pause in some of that economic data, or things to think about? Maybe we go back, we have more COVID pandemic breakouts, things like that. Things that people should at least be keeping on their mind as they're investing, buying things, etc.
Well, I think one part obviously is we don't know about all the variants on COVID-19, so something could still go wrong. We've got to be careful about that. But I think the bigger risk just comes from the speed of the recovery. The last economic expansion, well, I used to call it a healthy tortoise, because it would amble forward happily at about 2% growth, but just not doing anything really exciting at all. This one is much more of a frenetic hare. I mean, it's like a drag racing car. We are going to go from 14.5% unemployment down to 3.5% unemployment in the space of 3 years. And if you're in drag car racing, the one thing you want to make sure of is you got a good parachute on the back of the thing, because the danger is that we're going to grow so fast that we're actually going to cause inflation, and that could push up long-term interest rates a lot. And given the amount of government debt out there, that could cause some real problems. So we know the government's found the accelerator. I just want to make sure they also know where the brake is when they need it.
Let's hope they can find that. Dr. David Kelly, it is always a pleasure to get your analysis and to speak with you. I want to thank you so much for joining us on the program this morning. Have a great rest of your day, and we'll talk to you again very soon.
Anytime, Jeff.
Thanks, David. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Monday, I sat down with Johns Hopkins Medicine's Dr. Michael Blaha to discuss preventing heart disease in the mature and the young. Let's take a look.
The evidence suggests that risk factor control and healthy lifestyle choices actually matter more earlier in life than they do later in life. And that's probably because of the long time to accrue the benefit. We know that cholesterol levels that are healthy earlier in life are better even than having high normal cholesterol later. Healthy blood pressure earlier in life better. And also lifestyle changes, the healthy weight, healthy eating habits, not only do they form that habit throughout your life, but they mean more. They predict good outcomes better earlier in life than they do later in life. The most cost-effective way to control cardiovascular disease by far is lifestyle. This has been shown time and time again. But of course, if your cardiovascular disease gets advanced, you have to be on medicines and sometimes get procedures. But earlier on, you can manage your risk with lifestyle. So by far, on a population basis, lifestyle is the way to go. And absolutely, we always start with lifestyle. Hopefully, you're starting before someone even has the manifestation of cardiovascular disease and is adopting a healthy lifestyle to maintain kind of their health throughout their life. Now, of course, there is times when lifestyle kind of has its limits and we need to start medicines, for example, but we always start with lifestyle first. So the question is, can lifestyle control this? In many cases, it can, but of course, when you see your doctor and you watch your risk factors over time, sometimes you need medicines to assist with that. But if we do it right, and the combination of lifestyle and preventive medications, we can prevent the costly outcomes like heart attack, stroke, stents, bypass surgery that some of our patients, unfortunately, experience later on in life. We do have over the last 3 decades, a marked decrease in cardiovascular disease in this country, which has been a great success. And some of the low-hanging fruit, of course, was getting people to stop smoking, reducing trans fats in the diet, reducing salt intake, things like that. But unfortunately, we have hit a plateau, unfortunately. Over the last several years, cardiovascular disease rates have plateaued, if not increased a little bit. This is likely attributable to things like obesity and diabetes becoming the new replacements of things like smoking in the past. And there has been an uptick in premature disease in young people. And there's various hypotheses about this, but this could be everything from, opiates, other poor lifestyle choices in young people, including stress, things like that. So yeah, there's unfortunately some signs that we might be reversing our trends, and COVID adds a lot of complexity to this. We've done some research on this and trying to track people's lifestyle. In fact, we use actually Google tools to try to track people's lifestyle choices during COVID. And unfortunately, what we're seeing is sort of a bimodal distribution. Certain people, groups of people had their lifestyle improve. Maybe their stress reduced, maybe their eating could improve during COVID. But then there's a good host of people whose state of mind, unfortunately, was probably more depressed, who are walking and moving a lot less, staying in their home, who are likely to unfortunately down the road experience more cardiovascular disease. So I think it's going to be a very complicated thing to work through. But I think there's going to be a good number of people, unfortunately, that are going to be at risk for cardiovascular disease because of, things like physical inactivity, stress during COVID. So there's some interesting studies about things like, do people go to the emergency room less or more during COVID because of fear of COVID? Those are the immediate term effects, but the long-term effects aren't as clear. And I'm worried in particular about people who, for example, made a habit of going to the gym. For example, that was how they worked out. and all of a sudden they couldn't go to the gym. I have a lot of patients like this, and they say they haven't exercised much at all. Now, on the flip side, of course, there's the people who have a Peloton or something like that at home who've thrived in this setting. So it's just like a lot of outcomes, education outcomes, financial outcomes, healthcare outcomes are going to be very inequitable after COVID, I think, and we're going to have to understand that a lot more. But of course, I'm most concerned, like the patients you mentioned, you mentioned, who really have been sedentary during this time, maybe have been stress eating during this time, sleeping poorly during this time. We know those are risk factors for heart disease. So it's very interesting and very complicated times. And you're right, we're going to need a lot of good, high quality studies to figure this out. There's no way to know yet.
And on Wednesday, I spoke with the Institute of Student Loan Advisors, Betsy Mayotte, to discuss why advisors should be talking about student loan debt. Let's take a look.
Yeah, so this is kind of an interesting phenomenon. I think up until recently, most financial planners or wealth management experts didn't really pay much attention to student loans because their clients student loan debt didn't tend to be an issue for their clients. But what I'm seeing, especially over the last 3, 4, 5 years, is more and more financial planners and wealth management experts have been approaching me and organizations like mine looking for help because they are seeing more and more clients where student debt is an issue, whether it's their own student debt or they're concerned about their children's student loan debt, or maybe they took out Parent Plus loans. And that sort of, if you look at the data, it makes sense. These days, the average student loan borrower is a lot older than what we saw traditionally. I may have given you this data before, but half of all student loan borrowers are over the age of 30, a quarter are over 45, and the fastest growing population with student loan debt are the over 65s. So it's becoming more and more crucial for people that help other people with their finances to either have a resource or have a knowledge about student loan debt. So what we ended up doing is I created a student loan counseling boot camp, and it's a 3-day program, 3 hours a day. So it's no joke. It's 9 hours of pretty intense training, but users walk away with everything they would need to know to answer 99% of the questions they would ever get from a client about student loans. So we created one specifically for financial planners and wealth management experts. We're offering it April 24th, 25th, and 26th. So 3 hours a day over those. And there goes the cat again.
Yeah, that's okay. She's interested. That's fine.
Yep, she's my right hand. But so yeah, we're offering the course for 3 hours a day over 3 days. It's certified for continuing ed credits, so financial planners can get their continuing ed credits as well. And it's a really small class on purpose because I want to keep it interactive. We do a lot of case studies and so on. Student loan debt is becoming a big factor for retirement, whether it's people trying to save for retirement or people that are already retired. I get emails every day from borrowers that, maybe it's debt they took out for their kids, or, the 2008 recession is a big reason why student loan borrowers are trending older, because a lot of people went back to school and took on student loan debt in their 30s, 40s, even 50s. So it definitely, anyone who wants to provide a holistic package or holistic set of tools for their clients really does need to be educated about student loan debt and the options available to their clients. I'm seeing a couple things. I'm seeing some advisors that want to be educated about the programs themselves so they themselves can offer the holistic advice. I'm also seeing other organizations that are partnering with, say, someone like me or my organization, so they know they have a safe place to send their clients who have student loan issues. But it's becoming a lot more prevalent where they want to be able to offer the tools themselves, for sure. In fact, my calendar is starting to we do a lot of webinars and speak at a lot of conferences already, but I'm getting a lot more invitations for conferences to speak at conferences for financial planners. Then just in the last year, I would say those particular types of audiences has more than doubled. on my calendar.
Certainly great segments. I want to thank all of our contributors this week. And that wraps up this episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, all in one place, check out today's edition of our newsletter, The Morning Pulse, or our website. We're back again tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze and take a look at all the latest information this week. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.